Hi, today we're going to talk about capital structure optimization, mastering the debt and equity mix for sustainable growth. We are going to explore one of the most consequential decisions any chief financial officer will ever make: how to structure the capital that funds your enterprise. And this is not merely an academic exercise, by the way, or it's not a number on a spreadsheet. It's the way that you balance debt and equity, and that shapes everything. Everything from your company's daily operations to its long-term destiny. So, let me begin with a simple truth, and that took me years to fully appreciate. Capital structure is not about finding a perfect formula. It's about making thoughtful choices, and those choices that align with your company's strategy. It aligns with the stage of growth in the company, and it aligns with the economic environment in which it operates. There's no universal answer, by the way, but there are universal principles or guidelines that guide us toward better decisions. So I think it's best understood to think of your company as a house. The equity you have, whether it is from founders, investors, retained earnings, it's the money that you're putting down to buy that house, right? It's yours and it's free and clear. The debt that you take on is like the mortgage, right? It allows you to acquire something larger than you could perhaps afford with just your own funds. But like any debt, it comes with obligations. You must make the regular mortgage payments. And if you fail to do so, well, there are consequences, as you can imagine. Now, why does this even matter so much? Because the mix of debt and equity you choose, it determines your cost of capital. And your cost of capital is simply the price that you pay for the money that runs your business. Every investment you make, every project you pursue, every acquisition you consider, all of these must generate returns that exceed this cost. Otherwise, you're simply destroying value. You're not creating it at that point. And here's something that surprises many people when they first encounter it. Debt, despite its risk, is usually cheaper than equity. Do you know that? And this seems counterintuitive. Why would borrowed money cost less than money from the owners? And the answer lies in two factors. One is the tax treatment, obviously, and the other is risk positioning. Now, when you're paying interest on the debt, what happens? That interest is typically tax deductible. If your company earns a profit and pays taxes, every dollar of interest you pay, it reduces your taxable income. And this creates what we call a tax shield, commonly known as a tax shield. In effect, what the government is doing is subsidizing part of your borrowing costs. However, the dividends that are paid to the shareholders, by contrast, they come from after-tax profits. So there's no similar deduction. The second factor is risk. Lenders get paid before the shareholders. So if a company struggles, it must still service its debt, or it might face serious consequences, including bankruptcy. Shareholders, as owners, they bear the residual risk. They get what is left over after everyone else has been paid. Because shareholders take on more risk, they demand higher returns. And this makes equity a lot more expensive than debt from the company's standpoint. So if debt is cheaper, why not finance everything with debt? And this is where the art of capital structure begins. This is what we get paid for. Debt has a fundamental characteristic, and that can work powerfully in your favor, or it can devastate your company. It must be repaid regardless of how your business performs. And when times are good and your business is generating strong cash flows, the debt, it amplifies your returns to the shareholders. You're using relatively cheap borrowed money to generate these profits, and most of those profits, they flow to the equity holders. Now, this is called leverage, and it can be a fantastic wealth creator. On the other side, the flip side of the coin, if the revenues are declining or the margins are compressing, those debt payments, they remain fixed. They don't go away. They don't care that your customers are buying less or that a competitor has disrupted your market. Every month, every quarter, the obligations remain. And this is why the over-leveraged companies, the companies that have a lot of debt, they often fail during economic downturns. It's not that their underlying business have no value, it's that the fixed obligations are overwhelming. They overwhelm their ability to adapt and survive. So let me share a framework that I find very useful for thinking about this. Imagine a spectrum. On one end, you have a company that is funded entirely by equity. The company has maximum flexibility. It can reduce dividends during tough times. It can pivot its strategy without worrying about covenant violations. And it can weather extended periods of difficulty. But it is also paying the highest possible cost for its capital at that point. And its shareholders may wonder why management is not using leverage to enhance their returns. I mean, that's one side of the spectrum. High cost of capital because of 100% equity stake. On the other end of the spectrum, you have a company that is funded entirely with debt. And this company, they enjoy a very low cost of capital when things go well. And again, remember, the capital is being subsidized by the government. Its shareholders are earning extraordinary returns on this relatively small investment. But this company, it lives on a knife's edge. A single bad quarter or a couple of bad quarters and an unexpected market shift or an economic recession, and it could be put into distress. So most companies should position themselves somewhere in the middle of the spectrum. And where exactly it falls depends on several factors. The first factor is the stability of your cash flows. Look at that. If your company has recurring revenue, long-term contracts, or operates in a sector with very predictable demand, well, you can generally support more debt. A utility company or a subscription software business can comfortably carry relatively more leverage that would be reckless for maybe someone like a fashion retailer or a startup technology company to do. The more predictable your cash flows are, the more confidence lenders will have in you, in your organization, and the more debt your capital structure can prudently accommodate. The second factor is your industry's capital intensity. Some businesses, they require enormous investments in physical assets. I mean, that's real. If you're looking at manufacturing plants, you're looking at real estate, you're looking at equipment infrastructure, these assets, they often make excellent collateral for debt financing. For example, a trucking company can borrow against its fleet of trucks. A real estate developer can mortgage its properties. Asset-heavy businesses, they traditionally carry more debt. Why? Because they have tangible collateral that lenders can claim if things go wrong. Now, imagine a professional services firm or a software company whose primary assets may walk out the door every evening. So now these businesses have less collateral relative to the asset-heavy industries. And they do not have that much to pledge and often rely more heavily on equity financing. Their value lies in intellectual property, in customer relationships, in human capital. And these assets are very difficult to securitize. The third factor is your growth trajectory. Companies in high growth phases often need to preserve financial flexibility. They may need to make those acquisitions and make those acquisitions quickly. They may need to invest in research and development or expand into new markets. Heavy debt loads, it can constrain those opportunities. Debt covenants might come in, they might limit capital expenditures, or they might require lender approval for strategic moves. Now, mature companies with slower growth and abundant cash flow, they can optimize more aggressively for a lower cost of capital through the increased leverage that they get. There's a fourth factor that plays into effect, and that is often underweighted in many corporate finance textbooks, and that is the management's risk tolerance and the board's appetite for volatility. I have seen companies with very similar financial profiles, and they choose dramatically different capital structures based on the philosophy of the leadership. Some management teams, they sleep better at night knowing that they have a modest amount of debt and they have substantial liquidity. That's their preference. Now, others are more comfortable operating closer to the edge in pursuit of higher returns. Now, neither approach is inherently right or wrong, but it must be a conscious choice made with very clear and open eyes. So let's talk about how to measure this capital structure. The most common metric is the debt to equity ratio, and it simply compares the total debt on your balance sheet to the total equity. That's it. A ratio of 1 to 1 means that you have equal amount of debt with equity. That's it. Higher ratios indicate more leverage, lower ratios obviously indicate more conservative financing. But I want to caution you against fixating on a single ratio. Capital structure analysis, it requires looking at multiple measures. So consider debt to EBITDA, which shows how many years of operating earnings it would take to pay off your debt. Consider interest coverage. And what does that do? It measures how many times over your operating earnings could cover your interest expense on that debt. Look at net debt, and that is you subtract your cash and your short-term investments from your gross debt, and it gives you a clearer picture of your actual leverage position. What do you have? I also encourage you to look at peer companies in your industry. Now, capital markets have certain expectations for different sectors. A technology company with 2 times debt to EBITDA might be considered moderate, moderately leveraged, let's say. While the same ratio for a consumer staples company, it might be viewed as conservative. So understanding what is normal for your industry, it helps you communicate with your investors and lenders and ensures that you are not unknowingly positioned as an outlier. Now, with that said, let's discuss the practical process of optimizing your capital structure. And this is not a one-time decision, it's an ongoing responsibility and it requires regular attention. Start by understanding your current position. What is your existing mix of debt and equity? What are the terms of your debt? What is the interest rate, maturities, covenants? How much financial flexibility do you have? And what is your current cost of capital? And how does it compare? How does it compare to the returns that your investments are generating in the organization? All the initiatives that you're generating in the organization. Then look at the strategic plan. Where is the company headed over the next 3 to 5 years? And what investments are going to be required? What are the risks that might materialize, that might kind of change the fulcrum of value? Your capital structure should support your strategy, it should not constrain it. If you're planning a major acquisition, you may want to maintain some borrowing capacity. If you're entering a period of stability and cash generation, well, you might optimize toward lower cost of capital by what? By increasing the leverage, as I mentioned before. Analyze different scenarios. And what happens to your debt service coverage if revenue is declining by 15%? Think about the impact. What if if your debt is flexible rates and your interest rates, they rise significantly? You will need to refinance, don't you? What if your largest customer leaves? Stress testing your capital structure against adverse scenarios, it reveals certain vulnerabilities before they become a crisis. And finally, execute thoughtfully. Capital structure, it can change and it will be subject to change, and that's totally okay. Whether you're issuing new equity, taking on debt, paying down existing obligations, all of these decisions have real costs and market implications. Issuing equity, it will dilute your existing shareholder and sometimes signal that management believes that the stock is overvalued. Debt issuances, on the other hand, it will require negotiating terms and accepting covenants that might be restrictive. The timing and structure of these transactions, they matter enormously. So I want to share a perspective at the end that comes from experience rather than theory. The best capital structures are the ones that are most resilient. They are designed not just for the current environment, but for environments that might come in the future. the companies that struggled most during economic downturns were often those that optimized way too aggressively in the good times. They minimized their cost of capital by maximizing leverage, leaving no margin for error. In contrast, the companies that emerged the strongest from difficult periods often had capital structures, and they seemed inefficient during the good times, but they carried what critics generally tend to call lazy balance sheets, excess cash, modest leverage, untapped credit facilities. But when a crisis occurred and a disruption came, these companies had a lot of options. They could acquire distressed competitors. They could invest in innovation, and while others were cost-cutting at that point. They could retain their best people while others were being let go or being laid off. So this brings me to a final thought about capital structure that I believe is essential for every CFO to internalize. Your capital structure is not just a financial tool, it's a source of strategic optionality. The flexibility to act when others cannot, to seize the opportunities, to weather the storms, to make the long-term investments. And those are the ones that create enduring value. That flexibility often matters more than optimizing for the lowest possible cost of capital. As you think about your own company's capital structure, I want to encourage you is to move beyond the mathematical optimization and consider the broader context. What does your industry evolve? What does your strategy require? And what would happen in a severe downturn? What are the opportunities that might emerge that you would want the capacity to pursue? The goal is not to find the theoretically perfect capital structure. That's not the goal here. The goal is to find the capital structure that positions your company to create a long, sustainable value in the long term, obviously, through good times and bad times. And that requires judgment, it requires experience, and it requires a willingness on your part to revisit your assumptions as your circumstances change. Capital structure optimization is one of those responsibilities that separates exceptional CFOs from merely competent ones. And it demands that you integrate your financial theory with strategic thinking, that you balance those multiple stakeholder interests, and that you maintain the discipline to resist both the temptation of excessive debt or excessive equity on both spectrums. If you're able to master this balance, you'll have built a foundation that supports everything else your company seeks to achieve. Thank you for your attention. Look forward to seeing you in the next session. Take care. Bye-bye.